Welcome back, dear students and scholars. In the previous lesson, we built the cost pool for inventory. Now we move into ASC 330 cost flow methods, which answer one very practical question. When goods are sold, which cost leaves inventory? Is it the exact cost of the specific item, a standard cost, an average cost, the oldest cost, or the newest cost? The answer determines how much appears in cost of goods sold on the income statement and how much remains in ending inventory on the balance sheet. Same goods, same purchases, but different timing of profit. Cost flow methods exist because purchases often happen at different prices, but sales do not always identify the exact unit cost. Ending inventory tells us which costs remain as an asset at period end. Cost of goods sold tells us which cost became an expense during the period. Gross profit is affected because revenue is reduced by the assigned cost. The important memory hook is this: cost flow choice changes timing, not total lifetime cost. Every dollar of inventory cost eventually becomes cost of goods sold. The method only decides when that dollar leaves the balance sheet. Here is our learning path for this video. We will first understand the objective of selecting a cost flow method. Then we will separate physical flow from cost flow because the warehouse movement and the accounting assumption are not always the same. After that, we will cover specific identification and standard costing. Then we will calculate weighted average, moving average, FIFO and LIFO using one shared data set. Finally, we will compare the results and prepare for the next video where LIFO layers, pools, liquidations, and the LIFO reserve get their own deeper treatment. Under ASC 330, the cost flow method should clearly reflect periodic income under the circumstances. This is not just a random formula choice. Management should consider the nature of the inventory, industry practice, price trends, system capability, and user comparability. Unique items may support specific identification. Interchangeable goods may support average or FIFO. Volatile prices can make method choice more important because the difference in cost of goods sold becomes more visible. A defensible method is not just mathematically possible, it should fit the business and be applied consistently. A very common confusion is mixing physical flow with cost flow. Physical flow is the real movement of goods: which boxes left the warehouse, which items were shipped, and which materials entered production. Cost flow is the accounting assumption about which costs are assigned to goods sold and which costs stay in ending inventory. Only specific identification requires cost flow to match the actual unit sold. Other methods such as average, FIFO, and LIFO are accounting assumptions. So the warehouse may rotate goods one way while the accounting records assign costs another way, and that can still be acceptable. Specific identification traces the actual cost to the actual item sold. It works best when units are unique, high value, and low turnover, such as automobiles, special machinery, custom equipment, or other goods with serial numbers, vehicle identification numbers, or asset tags. The method is precise because each unit carries its own cost, but that precision has a cost. It is usually not practical for thousands of identical bolts, paint cans, or low value interchangeable items. Specific identification is excellent when individual tracking adds value. It is not excellent when the accounting department starts needing a microscope for every screw. Standard costing is a practical approximation method. In the slide example, the standard unit cost is built from materials of $26, labor of $9, and overhead of $5 for a total standard cost of $40 per unit. Each unit entering inventory is recorded at that standard cost, even if actual purchase or production costs fluctuate during the period. Under ASC 330, Standard costing is acceptable only if it approximates actual cost. That means standards must be updated at reasonable intervals, variances must be analyzed, and ending inventory must be reconciled to actual results. Stale standards are not a shortcut, they are a warning sign. Now we introduce the shared 2027 dataset that will be used for the calculations. The company starts with 100 units at $10, costing $1,000. It then purchases 150 units at $12, costing $1,800, and later purchases 100 units at $15, costing $1,500. That gives total goods available of 350 units, costing $4,300. The company sells 220 units, leaving 130 units in ending inventory. Costs are rising from $10 to $12 to $15, which makes the differences between the methods easier to see. Under the periodic weighted average method, we calculate one blended average cost for all units available during the period. Total cost available is $4,300 and total units available are 350, so the average cost is approximately $12.29 per unit. Cost of goods sold is 220 units multiplied by $12.29, which equals $2,703 after rounding. Ending inventory is 130 units multiplied by the same average cost, which equals $1,597. The reconciliation is 2,703 plus 1,597, giving the full $4,300. The moving average method is different because it is a perpetual method. The average updates after each purchase. After purchase 1, the company has 250 units costing $2,800. So the average is $11.20. If sale 1 is 160 units, cost of goods sold is $1,792. The remaining inventory is 90 units costing $1,008. Then purchase 2 adds 100 units at $15, bringing the total to 190 units costing $2,508, and the new average is $13.20. Sale 2 is 60 units at $13.20. So cost of goods sold is $792. Total cost of goods sold is $2,584 and ending inventory is 130 units costing $1,716. FIFO means first in, first out. It assumes the oldest costs leave inventory first and the newest costs remain in ending inventory. We start with the earliest layer, usually beginning inventory, then move forward through purchases until all sold units are assigned a cost. In rising prices, this usually produces lower cost of goods sold, higher gross profit, and higher ending inventory because the newer and more expensive costs stay on the balance sheet. FIFO often resembles physical flow for perishables or dated products, but it is still an accounting assumption unless the company is using specific identification. Now let us apply FIFO to the shared data. The company sold 220 units. Under FIFO, the first 100 sold units come from beginning inventory at $10, giving $1,000 of cost of goods sold. The next 120 units come from purchase 1 at $12, giving $1,440. Total FIFO cost of goods sold is $2,440. Ending inventory contains the remaining 30 units from purchase 1 at $12 or $360 plus all 100 units from purchase 2 at $15 or $1,500. Ending inventory is $1,860 and the check is 2,440 plus 1,860 equaling $4,300. LIFO means last in, first out. It assumes the newest costs leave inventory first and older costs remain in ending inventory. Under LIFO, we start with the latest purchase layer and work backward until all sold units are covered. In rising prices, this usually produces higher cost of goods sold, lower gross profit, and lower ending inventory because newer and more expensive costs go to the income statement. This slide is only the overview. In the next video, we will handle the more technical LIFO topics, including layers, pools, liquidations, and the LIFO reserve. Now let us apply basic periodic LIFO to the same shared data. The company sold 220 units. Under LIFO, the first 100 units assigned to cost of goods sold come from purchase 2 at $15, giving $1,500. The next 120 units come from purchase 1 at $12, giving $1,440. Total LIFO cost of goods sold is $2,940. Ending inventory contains the older layers, 100 units from beginning inventory at $10 or $1,000, and 30 remaining units from purchase 1 at $12 or $360. Ending inventory is $1,360. The reconciliation is 2,940 plus 1,360 equaling $4,300. This comparison shows why cost flow selection matters. The total cost available is always $4,300. No method creates or destroys cost, but each method allocates that cost differently between expense and asset. FIFO gives cost of goods sold of $2,440 and ending inventory of $1,860. Moving average gives cost of goods sold of $2,584 and ending inventory of $1,716. Weighted average gives cost of goods sold of $2,703 and ending inventory of $1,597. LIFO gives cost of goods sold of $2,940 and ending inventory of $1,360. Same facts, different timing. When prices are rising, FIFO and LIFO move in opposite directions. FIFO sends older, cheaper costs to cost of goods sold, so cost of goods sold is lower, gross profit is higher, taxable income may be higher, and ending inventory reflects more recent higher costs. LIFO sends newer, more expensive costs to cost of goods sold, so cost of goods sold is higher, gross profit is lower, taxable income may be lower, and ending inventory contains older, cheaper layers. Average methods usually fall between FIFO and LIFO. In falling prices, the pattern reverses, so do not memorize the result without checking the price trend. Choosing a method requires business judgment. Inventory uniqueness matters because unique high value goods may support specific identification, while interchangeable goods may support average or FIFO. Transaction volume matters because high volume systems may need methods that the ERP system can support efficiently. Price volatility matters because it makes the income effect larger. Tax and conformity matter because using LIFO for tax can require LIFO for financial reporting. Industry comparability matters because users compare companies across peer groups. System capability matters because layer tracking, moving averages, and standard cost variance analysis require reliable data infrastructure. Controls and consistency are essential. A company should have an approved accounting policy describing the selected cost flow method. The method must be applied consistently from period to period so users can compare results. The ERP or inventory system must be configured to match the policy. Inventory layers should reconcile to the general ledger and subledger. Standard cost variances should be reviewed and explained. If the company changes its cost flow method, that is generally a change in accounting principle under ASC 250, requiring proper analysis, retrospective application when required, and disclosure. Good controls keep the method from becoming a year end spreadsheet surprise, which is never the gift auditors are hoping for. Here are the common mistakes to avoid. First, do not assume cost flow must match physical flow. Only specific identification requires that match. Second, do not forget that moving average recalculates after each purchase in a perpetual system. Third, do not jump into advanced LIFO layer and reserve mechanics before mastering basic periodic LIFO. Fourth, do not treat standard cost as actual cost without variance analysis and reconciliation. Fifth, do not change methods casually. A cost flow method is an accounting policy, not a preference you change because this year's gross profit needs a little encouragement. Let us recap the 5 ideas to carry into video 4. First, cost flow assigns costs between cost of goods sold and ending inventory, so timing changes, not total cost. Second, specific identification traces actual units and works best for unique, high value, low turnover goods. Third, standard cost is a practical approximation only when standards are current and variances are analyzed. Fourth, average methods smooth cost fluctuations with weighted average used periodically and moving average updated after purchases in a perpetual system. Fifth, FIFO and LIFO respond strongly to price trends. Next, we go deeper into LIFO layers, pools, liquidations, and the LIFO reserve. If this lesson helped you connect the calculations to the financial statements, please like the video, subscribe to the channel, support the course, and share it with colleagues who are learning US GAAP. I will see you in the next ASC 330 lesson.